All right, we're going to go over some sample tests here. So, which of the following is considered to be cash and not cash equivalent? Well, a treasury bill is cash equivalent, money market fund is cash equivalent, certificate of deposit is cash equivalent, but a money order is considered to be cash. And number two, what is a cash equivalent? It is a short term liquid investment with an original maturity of 3 months or less. There are two acceptable approaches to recording sales discounts. It is the net method and the gross method. Number four, Frigate Company sold goods for $13,000 with terms 210 net 30. How much would Frigate receive if the account were paid within the discount period? So it would be 13,000 times 0.98. The 98 comes from 1 minus the 0.2, the 210. And when we do that, we get 13,000. 0.98 times the 12,740. Number five, what type of account is an account allowance for uncollectible accounts? That is a contra asset. Recording bad debt expense during a period when account is determined to be uncollectible, which is not generally allowed under GAAP, is known as the direct write-off method. And number seven, under the allowance method, the write-off of an uncollectible account has no effect on net income, right? Because it doesn't, we have that allowance account that's already the expense. Number eight, which of the following situations are a company's receivables sold to another entity? That's known as factoring. Number nine, Donaldson Corporation uses a periodic inventory system. On January 1st, inventory is $253,000. On April 5th, Donaldson sells inventory with a selling price of $75,000 on account. The cost of the inventory sold is $50,000. The journal entries to record the sale are, we would have it's so on account, so we won't debit cash, we will debit accounts receivable, and credit sales revenue, debit cost of goods sold, and credit inventory. B. Inventory costs do not include packaging costs. Smith & Miller Enterprises has inventory of 667,000 in its stores December 31. It also has two shipments in transit that left suppliers' warehouses on December 28th. Both shipments are expected to arrive on January 5th. The first shipment, 128,000, was sold FOB destination, and the second shipment, 8,000, was FOB shipping point. What amount of inventory should Smith Miller report on its balance sheet as of December 31st? Well, we'll have the 667. We do not include the one with the FOB destination, but we do include the FOB shipping point. So the 80,000. So that'll be 747,000. D. Walker Company provides the following information. What is the cost of goods available for sale? Well, goods available for sale is beginning inventory, which is 119,000, plus purchases of 510,000. It would also be freight in of 24,000, We would also subtract the purchase discounts. $5,200. We would also subtract the purchase returns of $8,000. So 119 plus 510 plus 24 minus 5. Crap. 119 plus 510 plus 24 minus 5,200 minus 8,000. I get 639,800 for A. All right, number 13. Gordon Company has the following transaction data available. Beginning inventory, and this is actually from the inventory, so we don't need to do these. These won't be shown on your test. So 13 won't be on your test. 14 won't be on your test. Number 21, what is a cash equivalent? We already determined that. A short-term hoodie sales discounts is the net and the gross method. Number 23, which of the following situations, we've talked about that, is factoring. We already did that one. Looks like I repeated the test when I put these together. Again, don't have that. $31 is an inventory question. $32 is an inventory question. It's another chapter. 33 is an inventory question. I think this one was the last semester we used the prior book, so that's why it's got different semesters on that. Got the Como Company borrowed $5,200 from his bank. Como will repay $7,300 in 5 years. What is the approximate interest rate that Como will incur on this loan, assuming annual compounding? All right, so we get out our we get out our present value table. So A, we take the 7,300, divide that by 5,200. And we get 1.4038. If we look at the future value of $1 here, and we know it's 5 years, so we go across the 5 years until we find 1.40255 is as close as we're going to get. And so that would be approximately 7% on that one. B, Lieberland Corporation deposits $125,000 every year in a savings account beginning at the end of the current year. For the next 6 years, it can purchase a new piece of machinery. At the end of the 6 years, the interest rate is 6%. how much money will Leland Corporation have at the end of 6 years? So now we want the future value of an ordinary annuity. And it's 6% for 6 years is 6.9753. And we're going to multiply that by the 125,000. And I get 871,913 rounded up. And then finally, number 3, part C, assume you have the opportunity to receive 7,000 at the end of each of 7 years, given 7% interest rate. How much would you be willing to pay for this investment today? So now we want the present value of an ordinary annuity. And we're going to use 7% for 7 years. And we get 5.38929 times 7,000. You would be willing to pay $37,725 on that one. And that's the end of the first test. That one wasn't very good. Like I said, I think it came from a prior book. It was actually a different author, so the chapters were in different order. So that'd be that.